When ChatGPT appeared, everyone thought it was the end of Google. However, since reaching its lows in November 2022, Google is now up almost 50%. As Mark Twain would say, the reports of Google's death have been greatly exaggerated. But is it still a good time to buy Google's stock at a fair price? Stay tuned and find out. Hey dudes and duderinas, this is the Finance Dude. Welcome to one of the most complete and exhaustive stock analysis on YouTube. Since this is a new channel, you can watch how my stock picking strategy works in full detail by clicking on the videos on the top right. In this episode, we have two missions. First, assess whether Google is a good business and has what it takes to move on to Analysis 2.0, and second, assess Google's valuation. Now sit back, relax, and get ready for some top-notch financial analysis. I always start this first approach with the 5 dimensions method, where I base my analysis on 5 different pillars: growth, profitability, solvency, valuation, and dividends. I won't bore you with every single metric in detail, but in the end, I'll show you the full table with the ratings. Let's start with the first dimension, growth. And let me tell you, Google's revenue growth has been remarkable. In just 10 years, they went from around $60 billion to $284 billion. That's an average growth of almost 17% per year. Insane. Needless to say, I'm giving them a rating of 5 for revenue growth. Moving on to net income growth, the growth has also been insane. No one can complain when you grow your profits from $12 billion to $58 billion in 10 years. However, at the end of 2021, Google's profits were at $76 billion, after an insane 88.8% increase in 1 year during COVID. Astonishing. Since then, revenues decreased 23%. Nonetheless, current profits are still almost 50% above 2020 profits. Given all of this and despite the fact we have to stay vigilant on the profits' future trends, I'll rate this with a 5. The same impressive growth is seen in free cash flow growth. In 2021, Google's cash flows grew by 73% to $51 billion, and although they have decreased by 19% since then to $41.7 billion, it's important to note that 10 years ago, their cash flows were only $8 billion. That's a remarkable growth. Once again, I give them a rating of 5 out of 5. Google has consistently shown impressive growth rates across all metrics. We're definitely off to a good start. Now, let's move on to the second dimension, profitability. First, let's talk about gross margins. Unfortunately, they have been decreasing over the past 10 years. After reaching a peak of 62.4% in 2015, the current gross margin stands at 55.3%, which is a significant decrease. This is definitely something worth investigating further if Google moves on to Analysis 2.0. Given this decline, I'll give it a rating of 1 out of 5. Moving on to operating, net income, and free cash flow margins, we see a consistent performance over the 10-year analysis period. For example, the operating margin has shown remarkable consistency, with 5 and 10-year averages at 25% and 25.1%, while the current value is 25.4%. Similarly, the free cash flow margin has remained stable, with 5 and 10-year averages at 14.6% and 14.8%, and the current value at 14.7%. This level of consistency is impressive. But ideally, we would want margins to grow, not remain consistent. Additionally, only the operating margin has a current value higher than the 5 and 10-year averages. Based on this, I'll give a rating of 2 for the operating margin, and a rating of 1 for both net income and free cash flow margins. Finally, let's take a look at return on invested capital. It falls just short of a rating of 5 because the current value is lower than the 5 and 10-year averages. Nevertheless, an ROIC over 30% is still considered outstanding. Therefore, I'll give it a rating of 4. So far, Google is showing promising results. But you know what else looks good? Hitting that like button. Do me a favor and smash it. Moving on to the third dimension, solvency. First, let's discuss the quick ratio. Over the past 10 years, Google's quick ratio has been decreasing, indicating either a decrease in current assets or an increase in current liabilities, which is not a positive trend. However, the current level of 2.32 is still as solid as a rock, indicating that Google has a strong ability to meet its short-term obligations. This deserves a rating of 5 out of 5. Now, let's talk about the debt-to-equity ratio. With a current ratio of 0.11, Google's debt is insanely small in comparison to its equity. This indicates a strong financial position with minimal reliance on debt. Therefore, I give it a rating of 5. Moving on to the net debt to EBITDA ratio, which has a value of -0.98. What this means is a company that has more cash than debt. This showcases excellent financial strength, and I give it a rating of 5 out of 5. Finally, let's consider the debt to free cash flow ratio. The most recent value is 0.7, which means that Google's cash flows generated in a single year are sufficient to pay off its entire debt and still keep some change. What an impressive feat. I give it a rating of 5. It's time to move on to the fourth dimension, valuation. Starting with enterprise value to sales, consistency is again the key word. The 5 and 10-year averages for this ratio are 5.44x and 5.43x respectively, and the current value stands at 5.41x. This suggests that Google's business is fairly valued business, at least in historical terms. That's a first on this saga of analyzing the components of the Russell 3000. Like we saw in Tesla, Microsoft, and Apple analysis, that you can find in the top right, all looked way overvalued relative to their historical multiples. We can also see that, at the end of 2022, this multiple was at 3.93x. Did you buy the stock back then, dudes? Based on these findings, I rate this metric with a 4 out of 5. The same holds true for the price to free cash flows and price to earnings ratios. In both ratios, the current values are trading around the 5 and 10-year averages, indicating again a fairly valued business. However, we will have the opportunity to delve deeper into this aspect in the upcoming sections. Lastly, we come to the not least important fifth dimension, dividends. Since Google doesn't pay a dividend, the metrics dividend growth, dividend yield, and payout ratio will naturally be rated 1. The only metric to be analyzed in this dimension is the number of shares outstanding. In the first 5 years of this metric, we can see clearly a gradual dilution of shareholders. From 13.5 billion shares outstanding in 2013, the number increased to 14 billion shares in 2018, adding 500 million shares into circulation. However, since 2018, Google has initiated share buyback programs, repurchasing over 1 billion shares. This is exactly what we want, dudes. By doing so, Google is increasing the portion of the pie that each shareholder holds. Considering the massive amounts of cash flows generated by Google each year, we can expect these buyback programs to continue. Despite the significant purchases in recent years, I will rate this metric with a 3. Now, it's time for the summary table with every 5D component. Having concluded this 5-dimension section, we arrived at final rating of 3.47. Massive. It's thrilling analyzing businesses like this. But this isn't it. We still have lots of work ahead of us, and this is just one data point in this investment process. But before we get to the juicy part where we dive into the company's valuation, I need a favor from you. If you're having fun watching this video and learning something new, please show some love and support to the dude by doing these 4 simple things. Subscribe to the channel, smash that like button, ring that bell, and spread the word to your peeps. Okay dudes, now that you showed your love to your favorite dude, we're ready to rock and roll with this DCF valuation. Before we dive into my assumptions, let's take a look at the historical averages of the variables we're considering in the forecasts provided by Wall Street analysts. One negative aspect is that revenue and cash flow growth have slowed down in the past year. However, this slowdown is understandable given that Google experienced impressive growth in 2021, with revenue increasing by 41.2% and cash flow growing by 73%. Considering the current economic environment, it's reasonable to see this deceleration. The question now is whether Google still has more growth potential or if it will face disruption from competitors like OpenAI and Microsoft. Another downside is the current price to free cash flow multiple, which stands at 38.44x. It's unrealistic to expect Google to maintain the same multiple over the next 10 years. It's always wise to be more conservative because, in the long term, growth is likely to decline, margins will stabilize, and multiples will adjust accordingly. On the neutral side, free cash flow margins have remained relatively consistent with the 5 and 10-year averages. The positive news is that Google is actively buying back shares, repurchasing 1% of outstanding shares each year. Now, let's consider the analysts' estimates. They project an average revenue growth rate of 10% and an average cash flow growth rate of 17.3% over the next 3 years. If cash flows are expected to grow at a higher rate than revenues, it suggests that analysts anticipate margin expansion in the coming years, which is very good news. Taking all these factors into account, we can now proceed with my assumptions and analysis. Let's begin by discussing the base case scenario assumptions. For the other scenarios, I will either be slightly more conservative or more optimistic to reflect different potential outcomes. Additionally, I will assign a probability that aligns with each corresponding scenario. First, let's consider the growth forecast for cash flow in the first 5 years of the projection. I have chosen to align with the forecasts provided by Google analysts, which indicate a 17.3% growth rate. For cash flow growth from years 5 to 10, I have selected a slightly lower rate of 10.0%. There's so much a company can grow, even in such a wonderful business. Another critical assumption is shares buyback or shares dilution. Since Google has been actively buying back its shares since 2018 and generates substantial cash flow each year, I will assume that Google will continue repurchasing shares at a rate of 1% annually for the next 10 years. Now let's look at Google's free cash flow margin. The highest values Google has achieved for free cash flow margin were 21.4% in 2016 and 20% in 2021. As mentioned earlier, analysts believe that Google's margins will expand over the next 3 years, and I certainly expect that, as the business matures, the higher the margins will be. That's why I chose a margin of 17% 10 years from now. To complete the base case assumptions, I need to define a price to free cash flow multiple. Considering that Google's current multiple of 38.44x is relatively high, I will select a more reasonable multiple of 17.5x. Here are the remaining assumptions for the other scenarios. After running the DCF model for each scenario, I obtained the following results, starting with the base case. In order to have my 12.0% required rate of return, if we believe that these assumptions will be met, then we should pay $118, a minus 4.9% downside from its current price. According to these assumptions, we expect Google to generate $150 billion in yearly cash flows by 2032, which is a challenging task. It's 3.5 times the current cash flows, and it implies an average growth rate of 13.59%. Do you think Google can achieve this, dudes? Let me know in the comments. Moving on to the bull case, if we believe that the assumptions for this scenario will materialize, we should be willing to pay up to $164.27, a 32.4% upside from the current price. This implies a rate of return of 14.9%, above my required rate of return of 12%. Nice. However, it's important to note that this scenario is less likely than the base case, as it requires several variables to fall in place, such as reaching nearly $1 trillion in revenues and $200 billion in cash flows. Around 3.3 times the current revenue, not an easy feat. But if you think that Google is able to pull this off, then we are about to see a great performance of Google's stock over the next 10 years. In the bear case, the assumptions indicate that we should pay $85.90 to have a 12% rate of return each year, a minus 30.8% downside. Interestingly, last time Google traded at this price was in January. If you had bought Google at this price, you only need this bear scenario to happen in order to have a 12% rate of return over the next decade. If you did it, then I take my hat off to you, dude. In extreme bull case, if everything goes according to these assumptions, then Google will reach a $5 trillion valuation in 10 years, more than 3 times its current market cap. Generally, these extreme scenarios only account with a probability of 0.5 to 1%, negligible. If by some miracle, this scenario comes to life, we would have a 18.6% annual return if we bought the stock at its current price. In extreme bear case scenario, according to these assumptions, buying the stock at the current price would result in a mere 1% rate of return. We certainly hope this doesn't happen. It's important to remember that these assumptions serve as an initial assessment of Google's valuation and don't consider qualitative information from more advanced analyses like Analysis 2.0. Before making any investment decisions, it's crucial to stress test these assumptions. But for now, I hope this gives you a good idea of where Google stands in terms of valuation. This is the summary table with all the scenarios' price targets and probabilities. The probabilities that I think best reflect the scenarios I made are 60% for base case, 24% for bull case, 14.5% for bear case, 1% for extreme bull case, and 0.5% for extreme bear case. Taking into account the probabilities assigned to each scenario, the final price target is $125.15, indicating an upside of 0.9%. This suggests that the stock is fairly valued, and buying at the current price would meet the required rate of return of 12% per year over the next decade. I think it's worth explaining why I choose a 12% rate of return instead of 10%. For example, if I had chosen a 10% rate, then the final price target would be $144.94, an upside of 17.6% to have a required return of 10%. If you understand the logic, if I chose a rate of 8%, then the price target would be $168.58. And this is key to understand what happened during COVID bubble. With interest rates and risk-free assets yielding around 0% and free money available for investment, investors were satisfied with any return above 0%. As a result, they lowered their required rates of return to 4, 5, or 6%, even for risky assets like stocks. However, now that there are alternatives yielding around 5% with no risk at all, investors demand a higher return for risky assets. If you had the dude back then, he would have advised you against buying into the bubble that was occurring, and that it would be only a matter of rising rates to see everything crashing back to earth. Therefore, I hope that the reason of why I choose 12% as my required rate of return is now clear, my dudes. As you can see from the graph, the stock has mostly traded within the blue area over the past year, briefly entering the green area. This suggests that based on this analysis, we may have missed an excellent opportunity to buy Google stock. Currently, the stock is trading within the bull case range, meaning that we would require more ambitious assumptions to achieve the 12% required rate of return. However, this is not a cause for alarm and think that the opportunity is missed. As observed, Google is trading near its fair price, only about 4% above our base case scenario. This indicates that a minor pullback in the stock price could present another favorable opportunity to establish a position in Google stock. But let's not rush ahead, there is still plenty of work to be done before making any investment decisions. Now, let's move on to multiple valuation to confirm the results we obtained so far. To determine a fair price for a company, we need to compare its current multiple to the best choice of 5 and 10-year averages. In the case of Google, the 5 and 10-year average multiples are quite similar and stable, making it not an obvious choice. However, in situations like this, I always prefer to choose the longer period for a more extensive assessment. By averaging all the prices, we arrive at a price per share of $124.09, indicating an upside of 0.0%. This multiple valuation analysis aligns with our previous findings and further supports the notion that Google is currently priced fairly in the market. Now, let's wrap up the first analysis of Google's business by comparing the three different data points: 5 dimensions, DCF valuation, and multiple valuation. One of our missions for today was to assess whether Google is a good business and has what it takes to move on to analysis 2.0. Well, the 5 dimensions revealed that Google is an outstanding business, earning a final rating of 3.47. Google excels in the growth and solvency dimensions, having a perfect score in these areas. However, it lags in the profitability and dividends dimensions. As we saw, Google's profitability has experienced some fluctuations across the analysis period. I prefer to see a business that consistently improves its margins. Additionally, Google does not currently pay dividends, resulting in a poor score of 1.5 in this dimension. Nevertheless, these setbacks are outweighed by several interconnected factors. Google generates massive amounts of cash flows, and rather than distributing them as dividends, Google reinvests this money into the business. This reinvestment has proven to be highly profitable, with a return on invested capital above 30%. In simple terms, for every $1 invested in Google's business, it brings in $1.30. That's truly impressive. Furthermore, Google also repurchases its outstanding shares, which is a tax-efficient way of bringing returns to shareholders compared to dividends. Our other mission was to assess Google's valuation. Both the DCF and multiple valuations indicate that Google is fairly valued. As Warren Buffett wisely said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So far, we have seen that Google is a wonderful business and is trading at a fair price. This is exciting. However, our journey isn't over yet. Google will move on to Analysis 2.0, where I'll conduct a deeper analysis to confirm the positive findings we've observed so far. If you want to learn more about how Analysis 2.0 works, check out the video in the top right corner. Be sure to subscribe to our channel and turn on notifications to stay updated when I post the next video. I'll dive deep to confirm that Google is indeed a great business. Stay tuned. Thanks for watching, and I'd love to hear your thoughts on Google's business. Do you think my assumptions were reasonable? And what are the next stocks you would like to be analyzed here? Let me know everything down in the comments. Peace, dudes. You rock.